Welcome to the Lane Gorman Trubit COVID-19 Financial Webinar Series. In this series, our accountants and advisors will provide you with information to make sure your business has the tools it needs to survive the 2020 coronavirus lockdown. Things are changing rapidly as our government fine-tunes the SBA loan program. This webinar will tell you about the best route to achieving PPP loan forgiveness. It was recorded live as a Zoom webinar on May 21st, 2020, and all information was accurate and up to date at that time. There is a Q&A at the end, but if you have questions, please feel free to email us at askus@lgt-cpa.com, and we will get back to you as soon as possible.
Welcome to our webinar on the SBA Payroll Protection Plan Forgiveness Application and Best Practices. Of course, the Payroll Protection Plan is referred to as the PPP plan. So I'm Colin Kanalakis. I'm a partner with Lane Gorman Trubit. I'm joined by two co-presenters, Denver Todd, Senior Manager, and Patrick Riley, his partner. While the three of us are all dealership specialists, this webinar will only have a few specifics to dealerships as we work our way through the presentation. This is a CPE eligible event, and if you'd like to get CPE, you'll receive up to 1.5 hours of CPE credit upon the completion of the class evaluation. The evaluation will pop up immediately following the webinar. Our Survey Monkey will pop up, and then that will allow you to take the survey. To ensure you receive your CPE credit, please take the survey following the webinar. If for some reason you miss out on taking the survey, you'll receive an email within 24 hours from Survey Monkey, where you'll be able to take the survey, and then once you do, you'll be able to download the link to this webinar and our other webinars for your viewing at a later time or sharing with others. For all of our dealership industry attendees, I wanted to let you know that we have our first Dealership Controllers Roundtable webinar next Thursday at 10 a.m. Central Time. James Taylor with SunTrust Robinson Humphrey, a division of Truist Bank, formerly BB&T SunTrust, will be presenting, focusing on the buy-sell environment for dealerships. We'll have our second Dealership Controllers Roundtable webinar June the 18th at 10 a.m. Central Time, partnering with Steve Rapolo from Fisher & Phillips. And we'll discuss COVID from the HR perspective. We'd love to have you attend these and other future Controllers Roundtable meetings. Please visit our Controllers Roundtable page on our LGT website. All right, we're ready to go ahead and get started. As you can see, we have a COVID resource page, and we will show this at the end as well. But it's a great place to be able to see all of the notifications that have gone out and all of our other great information that we've accumulated for our clients. We, of course, have to have the obligatory disclosure, which is the next slide. Well, I'm not going to read this. This is basically letting you all know this is based upon interpretation at the time. Things are constantly changing, and especially last Friday. We'll be going over a lot of those changes. All right, let's go ahead and move forward. Our agenda for today, we're going to start with going over 3 key frequently asked questions from the SBA, 31, 37, and 46. We'll then go over Notice 2020-32. We will talk about how much of the loan can be forgiven. We will walk through the forgiveness application and a couple of scenario examples of how it will ultimately work. We will go over best practices for managing your funds. I'm sure most of you have already received your funds, some just recently. It's still relevant to do that. And then we will go over some common questions that we've gotten from our clients. Slide, and I'll go ahead, and we're having a little bit of a delay in moving our slides forward, but as I mentioned, frequently asked question number 31 and 37 came out now several weeks ago, and this was the question that came out from the SBA about actually, should you have applied for these funds? Did you have a financial need? 31 addressed primarily large companies and public companies who had significant additional funds available or could raise additional money in the market. Then 37 came out. 37 actually brought all private companies into this question. So what happened is that everybody needed to start ensuring they had a really good story that explained their whole reason for applying for those funds. And that would start at the very beginning before you actually had the ability to apply for funds or even knew that the funds would be out there. So the guidance that we gave to our clients was to ensure that we had a very robust memo that explained what was happening with your business and the uncertainties at the time and uncertainties in the future. So basically, the way that we were working our way through it is to help ensure that you had a great detailed memo explaining why you needed those funds. Well, when frequently asked question number 46 came out, there was an exemption that was applied that allowed for any recipients of the PPP funds that received proceeds of less than $2 million in the aggregate between related companies, you would ultimately not have to provide this justification. You were basically carved out. Now, does that mean that everybody that has a loan of less than $2 million should not bother with it? No, we still feel that you should. We think it's a good best practice to ensure you already have it set up and ready to go. But those that are over $2 million, it's certainly going to be something that they will look at. All right, let's move forward. All right, this is the good faith certification. Frequently asked question number 46. Let's move forward to the next slide. Okay, one of the key items in frequently asked question number 46 has to do with this $2 million that we've mentioned. What happens though is that there are many people who the main owners of a business had multiple businesses, and there were separate applications for each business who had employees. And so overall, anytime that these companies have greater than 50% common ownership, they must be aggregated together. And if your aggregated loans get to larger than $2 million, you're still going to have this justification requirement when going through your forgiveness application. What this means is you're going to have to go over with the people who are reviewing your application the reasons why you applied and why you needed those funds. We'll go into a little bit more about that documentation later. The actual application talks through some key items that you will ultimately need. Now, there are a few carve-outs. We'll get to those carve-outs in just a little bit, but from a dealership-specific standpoint, any dealerships and also other franchisees that are on the franchise list and have a franchise identifier code are able to not have to aggregate all of these individual loans that are under $2 million. So we'll get into that a little bit later, but this was certainly a nice carve out that made things a little bit simpler. All right, in the application form itself, what's highlighted at the bottom, this is the key item here. And many people are going to ask you or ask what this means and how should I answer this. Simply, if your loan is less than $2 million, you do not check this box. If your loan is in aggregate is greater than $2 million with multiple loans, you might check this box. But in short, don't check this box on accident. All right, notice 2020-32. All right, so this is the notice from the IRS, but let's jump back a little bit and talk about what happens when your loan, part of your loan or all of your loan is forgiven because you have eligible expenses. And what got communicated was that this loan, the amount that's forgiven, will not be taxable income, which is wonderful. But the IRS rules, for any time you have a forgiveness of debt, typically that is taxable income. So what happens is, if your forgiveness is not taxable, in a case like this, if you had expenses, payroll, utilities, rent, etc., those items might or might not have been deductible. The IRS came out and said, look, our rules are consistently applied. Any expenses that would fall into a category like this, where you would have forgiveness of debt that is not taxable as taxable income, the underlying expenses will not be deductible. Now, we're hoping, many people are still expecting and hoping that you will still be able to get the deduction as well, which would provide an additional benefit to the recipients of these PPP funds. Okay, so the PPP did come out with the application, which helped answer a lot of our questions. back on Friday. It's 11-pager. The application has two critical supporting schedules. You have Schedule A, which is the summarization of the payroll costs, and then the Schedule A worksheet, which is the calculation of the cash compensation and FTEs. And I think, Denver, you're going to take over.
Yes, thank you, Colin. Okay, so good afternoon, everyone. I'm sure most people are here because of this PPP application, that forgiveness application that came out last Friday. We're going to go through the calculation and let you know the areas where there's additional guidance provided, and then still go over the items that we're still unclear on and we need future guidance on. But before we get into the details, it's important, because this covered period will be referenced a lot. It's important to understand what that means. So the covered period, it's the 8-week period beginning when you receive your PPP loan proceeds. It's the date you receive the money from the lender. In the instructions, there was actually something that was unexpected. There was what's called an alternative payroll covered period. And if you're a borrower with a biweekly or more frequent payroll schedule, you can actually align your payroll costs or your payroll period up so that they all fall in, so the 8-week period falls within your payroll period. And I have an example of how this works. And this only applies to payroll costs. The other non-payroll costs, you will have to follow the covered period, which is the date you receive the loan proceeds. So here's how the alternative payroll covered period works if you choose to elect it. Let's say on Monday, April 20th, you receive your PPP loan proceeds. Sunday, April 26th is going to be the first day of the first pay period that starts following your PPP loan disbursement date. If you elect the alternative payroll covered period, you can essentially you can start your covered period for the payroll costs on April 26th, and they go through June 20th. So it neatly aligns your payroll periods. Like if you're on a weekly, each of the 8 weeks would all fall within the 56 days. You'll just have to do the math to see if this is more beneficial or not. And as mentioned below, the non-payroll costs, you have to continue to use the covered period, which would be the day the loan proceeds were received, and that starts the 8-week period, or 56 days. Okay, so since this webinar qualifies for CPE, we're going to have 3 questions throughout the presentation. Here is the first one, and when you go to apply for the CPE at the end of the presentation, you'll have to provide the answers to these questions. So write them down if you're going to be applying for the CPE. So for the first question, how long is the covered period for your PPP loan? 12 months, 8 weeks, 3 months, or none of the above? The question that actually pops up on your screen is asking if you're still watching. You just need to mark yes for that, but you will need the answer for this question when you go to apply to receive CP if you need it. And the answer, as discussed a slide or 2 back, is 8 weeks. So just make sure you write that down. And actually, interesting enough, and we might talk about it later, but there's actually a bill in the Senate right now where they're proposing to expand the covered period to 16 weeks. And then in the House of Representatives, there's a bill where they're trying to expand the covered period to 24 weeks. So it's potential in the next month or so that this covered period that would have been 8 weeks can be extended further out. So something just to keep in mind. Okay, so we're going to talk about the costs that are eligible for forgiveness, because what happens is once the 8-week period starts, you're going to keep track of all the costs that you paid that are eligible for forgiveness, and it's going to go into the calculation to see how much of the loan that can be forgiven. The first type of cost is your payroll costs. And in the application, just added more clarity, it's your gross salary, tips, commissions, or paid leave. And it mentioned that it has to be paid or incurred during the covered period, or alternative payroll period. So that's very important that it says paid or incurred. I'll come back to that in a second. Secondly, for each individual employee, your total compensation over the covered period, which is the 8 weeks when you receive the loan, or if you select the alternative payroll covered period, you're going to be limited to $15,385 for each employee. So what that means is if you have an employee that you paid $20,000 over the 8-week covered period, you would only get to count the first $15,385 in your forgiveness calculation. In the comments down there, there's some tables. I'll get to that in a little bit to explain how this all works. So this is something that's actually a pretty big deal. It was in the applications, in the application that came out last Friday, but nowhere in the CARES Act. There's a limitation on the amounts paid to owners, and it's still a little bit unclear on what owner employees are, but currently the application says owners defined as owner employees, a self-employed individual, or a general partner. I would assume an owner employee would be an S Corp shareholder, but we'll need to know more in the future. And what's significant about this limitation is the compensation over the 8-week period is going to be capped at $15,385, or the 8-week equivalent of their applicable compensation in 2019, whichever is lower. So if you have a owner that did not receive compensation in 2019, but started paying themselves over the 8-week period to increase their payroll costs, it looks like based on how the application, you're not going to get to include any of that compensation paid to the owner because it's the lesser of the 15,385 or whatever you paid, or what you paid in 2019. And if you paid nothing in 2019, you won't be able to include any of those wages that you paid to the owner in the calculation. And secondly, too, there's a little confusion on, it says self-employed individuals and general partners. When you go to apply for forgiveness, it's going to be, I believe October 31st might be the last date you can apply for forgiveness. I know it's sometime in 2020, but to know the numbers for your self-employed individual, which would be from a Schedule C, or to know the amount on a general partner for their 2020 8-week equivalent for the covered period, you would have to have their 2020 tax return, and that won't be completed until 2021. So it's likely where it mentions self-employed individuals and general partners, you're going to be using their 2019 numbers when you're calculating this, but we're going to need more guidance to know the exact answer. Okay, so I mentioned previously, I talked about the cash compensation. There is also non-cash compensation, and this hasn't changed much. Just to recap, it's employer-paid contributions for employee health insurance, employee retirement plans, and then also any employer-paid state and local taxes assessed on employees' compensation, such as unemployment. Like if you're in Texas, you have the Texas Workforce Commission, you have to pay unemployment for employees. And something that we've heard rumblings of, but I haven't seen anything yet, I've also heard potentially that the non-cash compensation, you won't be able to get to include the owner's portion. I'm not sure about that yet, but just something to keep in the back of your mind as you're going through this. Okay, as I mentioned before, it said paid or incurred. So payroll costs, when do they have to be paid? So the CARES Act, in the language, it said costs incurred and payments made during the covered period. A lot of people interpreted that, including myself, to mean that you're essentially on a cash basis. But the application came out with a little bit more favorable to the borrower, where it stated in numerous spots, and I'll go over the first one, borrowers are generally eligible for forgiveness for the payroll costs paid and payroll costs incurred during the 8-week period. So it seems like you can count both. And then on the next slide, to elaborate on it more, payroll costs are considered paid on the date paychecks are distributed or the borrower originates an ACH transaction. And then payroll costs are considered incurred on the day that the employee's pay is earned. In the application, it had the following sentence that stated, payroll costs incurred but not paid during the borrower's last pay period of the covered period are eligible for forgiveness if paid on or before the next regular payroll date. So for example, if your covered period ends in the middle of a pay period, based on what it's saying, it seems that you would be able to count the payroll that has been incurred up to the last day of the covered period, even though it hasn't been paid. As long as it's paid on the next regular pay date, you would still get to include that incurred portion. So it's like accrued expense, essentially. You get to count it. What the application also says is when you're counting payroll costs, you only get to count payroll costs that were paid and incurred once to avoid double dipping. Back to what I was just talking about. So it seems like there's very favorable guidance in this application. And I'll just read this. It seems that the costs are eligible for forgiveness even though they were incurred before the cover period, but paid during the period, while other costs may be eligible for forgiveness even though they were incurred during the cover period, but paid after the period. So the application spoke to payroll costs that were incurred during the period, but paid after the covered period, but it didn't talk about any payroll costs or non-payroll costs that were incurred before the covered period, but paid during the covered period. So I think this is going to be addressed in a future FAQ, but really the question comes out, let's say if you didn't pay any of your March wages, but you did so immediately after you received the funds in April, would those wages still be eligible for as a payroll cost? I mean, you paid them in the covered period. It seems as so you'd be able to include them, but we'll have to see what the SBA and the Treasury come out with. Okay, so now I talked about the payroll costs. Now we're going to talk about the non-payroll costs that are eligible for forgiveness. These did not change that much. There wasn't really anything new on this. Just to recap, it's your business mortgage interest payments on debt that was incurred before February 15th. Just keep in mind you cannot include any prepayments or the payment of principal. And then your rent or lease payments, as long as you had a lease or rent agreement enforced before February 15th. And then also your business utility payments for the items mentioned below, as long as the service began before the February 15th date. A lot of people ask about what the definition of transportation means. No one knows. We have to wait for future guidance to know what they mean by putting that word in the act. Okay, so again, as I mentioned with the payroll costs, when do the non-payroll costs have to be paid? And what the application says is that eligible non-payroll costs must be paid during the covered period, or it does use the word or in the application, or incurred during the covered period and paid on or before the next regular billing date, even if the billing date is after the covered period. So the big question on this one is, can you, currently there's nothing that prevents you from prepaying rent or even utilities, I guess. There is, in the act, it prevents you from prepaying mortgage payments, but nothing with rent or interest. I think they're gonna shore this up and issue FAQ to prevent people from prepaying multiple months in advance on rent. But currently how it's written, it seems like you could include it, but I'm sure there's going to be more guidance that comes out soon that addresses this. Okay, so to recap, how much the loan will be forgiven. Usually you would think you add up all your expenses that you incurred over the 8 weeks, and you would think they'd all be forgiven on a tax-free basis. That's what you'd hope. And the types of payments that would qualify, as I mentioned before, are the payroll costs or the non-payroll costs. As you'll see on the next slide, it's not that easy. And at the bottom, there's eligible non-payroll costs cannot exceed 25% of the forgiveness amount. You'll see when Colin goes into examples how this actually works. Okay, as I mentioned, I wish it was as easy as just adding your payroll, non-payroll costs, which are line 1 through 4. This is from the application. I wish it was that easy, and as if you got a loan for 100,000 and you added up all those expenses and it added up to 100,000. I wish it was as easy as saying, yep, you get the whole loan forgiven, but unfortunately, it's not that easy. There are 2 potential reductions that you can have to your total payroll costs and non-payroll costs. The first one is if you have a salary or hourly wage reduction, or if you have you have to do a full-time equivalency test to determine if you had a reduction employees during the covered period. And the hourly and salary wage reduction test is determining if you reduce employees' pay during the covered period. So we're going to get into that. And as I mentioned on the previous slide, the loan forgiven can be reduced if you cut people's wages or you reduce headcount. And the key word is it could be, because there's safe harbors that could help you out. And then secondly, if you did receive an EIDL loan advance, that would reduce your forgiveness amount. So we're coming up to the second CPE question. True or false? The amount of the loan forgiven will be reduced if you receive a $10,000 advance under the Economic Injury Disaster Loan Program. And remember, you just need to write down the answer to this one, because the box that's popping up is just asking if you're watching. Okay, so the answer is true, as previously discussed on the previous slide. Okay, so as Colin mentioned, the very beginning when he briefly talked about the application, there's the application where you calculate the loan forgiveness, which I showed a slide or 2 back. There's supporting schedules that go into that application. The one where you're going to do all the work and lay all the foundation is this PPP Schedule A worksheet. This is where you're going to do most of the work. Now, just looking at this, you'll notice there's 2 tables. There's really only 2 differences between the 2 tables. If you look at table 2, there's no column for salary or hourly wage reduction. And then on table 1, there's this FTE reduction exception. We'll get to that in a little bit. But let's talk about why there's table 2 is missing the salary or hourly wage reduction column. The reason being is when the act was written, there was language in there that stated if the borrower paid employees compensation at an annualized rate of more than 100,000 for any pay period in 2019, you did not have to do the salary or hourly wage reduction test on them. That's why if you look at table 1, it's saying list employees who receive compensation from the borrower at the annualized rate of less than or equal to $100,000 for all pay periods in 2019, or were not employed by the borrower at any point in 2019. So if you employed anyone in 2020 in the first quarter or before the covered period starts and you're paying them over a $100,000, that does not bump them down into table 2. It's only employees that get bumped down into table 2 if they got over $100,000 for any pay period in 2019. And one question that came up, a lot of people were asking, do you have to do the salary and hourly wage reduction test on employees that were let go or fired before the covered period started? And you do not, because if you look at table 1, it says list employees who were employed by the borrower at any point during the covered period or the alternative payroll covered period. So you're only listing employees that were employed during the 8-week period. Okay, so this is our first reduction that we're going to talk about, the salary or hourly wage reduction. So it's a reduction, you'll get a reduction in the forgiveness amount if there is a reduction over the 8-week period that is in excess of 25% of the total salary and wages of the employee during the first or during the period from January 1st, 2020 through March 31st, 2020. So what that's saying is you look at the what their annual salary or hourly amount was over the 8-week period, and then you're going to compare it to Q1 of 2020. And if you paid them less than 75% over the 8-week period, and you'll see how the math works in a slide or two, then you potentially have a reduction. And just to beat this to death again, on the previous slide where we had table 1 and table 2, this reduction only applies to employees that did not receive over $100,000 for any pay period in 2019, or employees that were hired in 2020. Let's say, for example, you have a employee that gets paid monthly, and usually they get $5,000 per month. So if you were to multiply that out per year, that's $60,000. So they're getting, each month they're getting $5,000. So they're under $100,000 annually. Well, let's say in 2018 that they did such a great job that you wanted to give them a bonus in 2019. So in January of 2019, not only did they get their $5,000 that they usually get, they also got another $6,000, which made their pay $11,000 for that first pay period in 2019. That would mean if you annualize that, just that one period, they would have made over $100,000 for that one pay period. That bumps them out of table 1, and now they're going into table 2. Okay, so let's calculate the reduction. So you're going to have to gather some information. So you're going to have to determine the average annual salary or hourly wage for each employee during the covered period. You're going to have to determine the average annual salary or hourly wage for each employee during the period from January 1st, 2020 through March 31st, 2020, which is Q1 of 2020. I have an example in a second that goes over this. This is going to be a little difficult to follow and digest, and it's easier to learn by examples, but let's just walk through this real quick and then we'll go to the example. So you divide step 1 by 2. So you divide their annualized salary over the covered period divided by what their annual salary was for Q1 of 2020. And if their annual salary was at least 75% of their Q1 salary, then there's no reduction required. You just move on to the next employee. Oh, by the way, I don't think I mentioned it yet. You got to do this test for every employee that's in table 1. Not something you wanted to hear, so I'm sorry to let you know about that one. So the salary and hourly wage reduction, if step 3, which we just discussed, is less than 75%, meaning you didn't pay them over the 8-week period, you didn't pay them at least 75% of what they made in Q1 of 2020, you're going to have a reduction unless you meet a safe harbor. I'm going to follow along how the application does the test, and we'll go through example. So the application immediately goes to the safe harbor if you're under 75%. So if the employee's average annual salary or hourly wage for the period from February 15, 2020 through April 26 is less than the employee's annual salary or hourly wage as of February 15th, you need to determine the employee's annual salary or hourly wage as of June 30th, 2020. So the key here is when you have to find the amount at February 15th, and then there has to be a drop between February 15th and April 26th. If there's no drop, then you don't qualify for the safe harbor. It doesn't seem fair, but it's just how it's written, or how the act was written. So if let's say you did have a drop, so what you do is you take your June 30th annual salary or hourly wage amount and you compare it to February 15th. If your June 30th amount is greater than or equal to your February 15th amount, the safe harbor has been met and you have no reduction for that employee. So here's another way to view it. The main thing here is because no one knows what the person's salary is going to be at June 30th right now, and everyone's trying to plan ahead. So the main thing is you got to find the employees that had a drop in their salary between February 15th and April 26th compared to February 15th. And if there's a drop, then that employee can potentially qualify for the safe harbor. So then you need to, if you want that employee, if you don't want to get hit with the reduction for that employee, then you'd want to increase their annual salary or hourly wage on June 30th or whatever pay period falls within June 30th to be greater than or equal back to what they're being paid at February 15th. This seems like it could be easily or could be met in a way where could someone just increase their pay just for that June 30th pay period and then cut their salary the next week later? That seems too easy to basically meet this test and then basically the next week or whatever the next pay period is, chop their salary back down. So this is how it's written right now. So all you got to do is meet how it's written, but I'm sure there's going to be some FAQs that address this because it could be met pretty easily in a sense. Okay, back to a few slides back where we talked about we did the division and we were less than 75%, so meaning we didn't pay our employee at least 75% of their Q1 annual salary over the 8-week period. And then we don't meet the safe harbor, so now we got to do the calculation for the reduction. And this is going to be a lot to digest right here, and you're going to learn more by seeing the example, but let me just read through this real quick. You're going to multiply the amount determined in step 2 by 75%. So you're multiplying your annual salary determined in Q1 by 75%, and then you're subtracting what the annualized salary that you paid over the 8-week period. You're going to come up to a number. For a salary employee, you're going to take that number and multiply it by 8 and then divide by 52. That's your reduction. For an hourly worker, you're going to take that result. You're going to multiply it by the average number of hours worked per week by that employee for the first quarter of 2020. Then you're going to multiply it by 8 and divide by 52. I probably just lost everyone. Let's do an example so we can understand how this works. Okay, so you have employee Z was paid $4,000 during the 8-week covered period. Z was paid $10,000 for the first quarter of 2020. So we need to come up with the employee's average annual salary for the 8-week covered period. So we take 4,000 divided by 8 weeks and then extrapolate it out to an annual amount by multiplying it by 52. For step 2, we need to come up with Z's annual salary for the Q1. So what we do is we know he got paid $10,000 in Q1. We multiply it times 4 because there's 4 quarters in a year. You come up with 40,000. So what you do is you take his 8-week covered period annualized salary and you divide that by his Q1 annualized salary. You come up with 65%. It needs to be at least 75% not to have a reduction. So we're going to have a reduction here unless we meet the safe harbor. So assuming Z does not meet the safe harbor, we would calculate the reduction, which would be $615. So how you get that is you take the 40,000 that you calculate in step 2 and multiply it by 75%. That comes up to 30,000. You take the 30,000 and subtract out the annualized salary that he received over the Q1, which was 26,000. You come up with $4,000. You multiply that 4,000 by 8 and you divide by 52, you get 615. And you got to do this for every employee that are in table 1. Now here's another way to think about it. This might be easier for people to understand how the reduction's coming up with. Same example, just presented a little different way. You had that employee that got first quarter wages of $10,000. If you annualize that first quarter wages and you broke it down to a weekly pay amount, it'd be $769 per week. How the rules work is they want you to pay at least 75% of that Q1 annualized wages. So 75% of $769, that's where the $576.92 come from. So you at least need to pay your employee $576.92 for each week in the 8-week cover period to meet the 75% test. But in our example, that employee only was paid $4,000. You divide 4,000 by 8, so he was getting a weekly pay of $500. So essentially what's happened is that employee got shorted $77 per week. You multiply that by the 8 weeks, that's where you get the 615 from. Now I'll mention here, there's a lot of people that have asked the question, do I have to pay, if I want to meet the 75% test so I don't have this reduction, do I have to pay the employee $577 per week? That's not how the calculation, the answer is no, that's not how the calculation works. The calculation takes the total amount that you paid over that 8-week period and annualizes it. So you could actually pay the employee nothing in week 1 through 6, and then in week 7 and 8, you can pay them an amount that will average out to the $577 per week. Now, the only thing I'd caution about taking that approach is that employee, if they left before you got to week 7 and 8, where you basically made them whole for the 75%, you're going to get hit with a reduction because that employee left before you were able to pay them the 75%. So that's something just to keep in mind. Here's just another way how this information is presented. And you'll have the slides to look through. Okay, just real quick, a per hour example. So Z, instead of being an hour, a salaried employee, he's now hourly. So he's paid $28 in the first quarter of 2020. His pay was cut to $15 per hour during the covered period. So assume we did not increase his hourly rate by June 30th. What that's getting at is to meet the safe harbor. So we're not going to meet the safe harbor. So now we have to figure out what Z's average hours worked per week from 1/1/20 to March 31st, 20, which is the first quarter of 2020. It's going to be 30 hours in this example. So what you do is you take $28 times 75%, you get $21. Then you subtract out $15, you get $6. That's essentially what he was shorted per hour. You multiply it by 30 hours, you get 180 per week, and then 180 times 8, that's where you get your amount that he was shorted over the 8-week period. Essentially, the amount that his salary was reduced, or his hourly amount was reduced in excess of 25%. And here's another another way this is presented. This is actually goes through how the form or the application calculates it. So with all that, all we have done so far is just calculate that salary and hourly wage reduction column in table 1, but the rest of this will pick up speed, so don't worry. All right, now we're going to talk about the average full-time equivalents. Okay, so to determine the average full-time equivalents, you're going to take, for each employee, you're going to determine their average number of hours worked per week over the period, and you're going to divide it by 40. And you're going to round to the nearest tenth, and the maximum amount for each employee is 1. So if someone works more than 40 hours, you still put 1 there. And I know there was a lot of discussion before where people thought that other webinars where it would be based on 30 hours, which the 30 came from the Affordable Care Act, which is Obamacare, and they ended up not following those rules and came up with their own in this application. And then alternatively, you can use 1 for every employee who worked 40 hours or more per week. And you can use 0.5 for anyone that worked less than 40. That's the simplified method. Let's see how this works with the example. So you have 5 employees. You have 1 employee that worked over 40, you have 1 that worked 40, and then you have 3 that worked below 40. So if you're to do the calculation, just the regular way that you're supposed to do it, you come up with 3.7 full-time equivalents. Just to note that employee A that had 50 hours per week, he only counts as 1 because it's anyone that has 40 or more hours, they count as 1. And then if you do the simplified method, you actually come up to 3.5, so it's not as favorable. It's more favorable to do the regular method. But you're going to have to do this calculation not only for the covered period, but you're going to have to go back to the look back periods that I'm going to discuss in a second, and just you're going to have to do the math and see what makes sense, because ultimately you want the result that gives you the most loan forgiveness. You're going to have to put the average FTE for each employee that are on these tables. But there's also this, what I've circled here, this FTE reduction exception box where you're going to have to, you can put a number here. And in the application, what it says is any position where you made a good faith written offer to rehire an employee during the 8-week period and the employer rejected it, or for any employees that were fired for cause, voluntarily resigned, or request a reduction in hours. Apparently that's not going to count against you. I'm not sure exactly how all this is going to work, because what if that employee was only working 20 hours before? Do you get to count them as one, or do you count them based on how many hours they're working before? I'm not sure what number you're going to put there. I assume number one is based on employees that were let go before the covered period started, and then you offer to rehire them to get your FTE count back up. Whereas number two is just employees that, for various reasons, you had to reduce your count for those reasons during the covered period. You can possibly, it won't hurt you. I just don't know what number you're going to put in FT in that box that I showed you on the previous page. So I think we're going to need more an FAQ or guidance to explain how this works. And last but not least, that last comment, in all the cases, you only get to count the FT for either of these scenarios if you did not refill that position with a new employee. Now I'm going to talk about, I talked about the salary and wage reduction, which was the first reduction that you have to account for. Now there's a second one called the full-time equivalency reduction, or it's where you reduce your headcount. So how this works is you're going to take your average number of full-time equivalents during the covered period, and you're going to compare them to 2 look-back periods, or a third if you're a seasonal employer. And what you're going to do is you're going to divide your FTEs over the covered period by one of these look-back periods, and you get to choose which one you want. The one that has the least FTEs is going to be the more favorable. You'll see how the calculations work in a little bit. But the last note here is there is, like on the salary and hourly wage reduction, there is a safe harbor that can prevent this one from occurring. This is actually the reduction that can take a huge chunk out of how much can qualify for forgiveness. So it's very important that you pay a lot of attention to this one and run the numbers in advance, because you really need to keep this in mind, because it could hurt you at the end if you're not paying attention to it. Okay, so here's an example. Yeah, business X had 10 FTEs during the 8-week covered period after you received the loan proceeds, and then during the look-back period of February 15th to June 30th of 2019, you had 16 FTEs, just as you did from January 1st, 2020 to February 29th, 2020. So both the look-back periods have the same FTEs. I did that to make the example easy, but if there were differences in FTEs between those two, you'd want to pick the one that has the lesser amount, because as you see below, the FTE reduction quotient is 0.625, which is 10 divided by 16. So in other words, what's going to happen is when you go to the application, you're going to have to take all your payroll, non-payroll costs that you expended during the covered period. You're going to add them up. Then you're going to subtract out what your salary and hourly wage reduction was for all your employees. You're going to come up to a net number. That number is going to be multiplied by the FTE reduction quotient. And whatever that number is, that's going to be one of the options that you have for what your forgiveness is going to be. But stated another way, if this was your example, your eligible payroll and non-payroll costs are going to be reduced by 37.5%. If you had $100,000 that you wanted to qualify, and because you cut your employees, you're only going to have 62,500 that would qualify for forgiveness. So this can hurt you pretty bad. As I mentioned before, there is a FTE reduction safe harbor. This is very similar to the one for salary and hourly wages. So if the borrower reduced its FTE employee levels in the period beginning February 15th and ending April 26th, and then restored its FTE employee levels by not later than June 30th to the FTE levels that the borrower had included on February 15th, you'd be exempt from the FTE reduction. So basically what that's saying is, you look at your FTEs at February 15th, you come up with a number, then you see what your average FTEs were from February 15th to April 26th. If there is a reduction to your FTEs over that time period compared back to February 15th, then it's possible you can qualify for the safe harbor. So you need to see what your FTEs will be at June 30th. And as long as you get your June 30th FTEs to match what your February 15th FTEs were, or to be greater, then you'd qualify for the safe harbor. Big picture here, let's do example. You have 15 FTEs for February 20th or February 15th. From February 15th to April 26th, you have an average of 10. So how this works is by June 30th, I know we're not there yet, but if you did have that drop, you'd want to get your FTEs back up to 15 if you were getting hit by a reduction, because then it will allow you to be exempt from the reduction. One thing to note, and this doesn't seem fair, like I mentioned before, if you actually increased your FTEs during that February 15th to April 26th period, you don't qualify for the safe harbor, which doesn't seem fair because it just doesn't, but it is how it is. Maybe they'll issue more guidance or change how this is working, but for now, essentially is what it is. And then finally, determining your final forgiveness. The amount forgiven is going to be the lesser of your total payroll costs and non-payroll costs, less your salary and hourly wage reduction, and then you're going to multiply that by your FTE reduction quotient. And if you're exempt from the FTE reduction quotient, it'd actually be 1, so you wouldn't have essentially any reduction. It's going to be the lesser of that, or your PPP loan amount, which is the funds you got when you applied, or your payroll cost divided by 75%. Now with that, I am going to turn it over to Colin for some examples.
All right, everybody. So we're going to start out by going over the application. This is the 11-page application that Denver has referred to and we talked about a little bit earlier. We're not going to be going line by line through this. That would take a long time. We're going to talk about just some big picture items in here. As we stated, there are multiple different spreadsheets that you have to complete. However, you only have to submit this number 1 and number 2. So make sure you're aware of that. The PPP loan disbursement date, they actually define in here that the date of the beginning of your covered period actually is the date you received funds. I know there were some questions about what's the date of your approval of the funds, the date of notification. It's the date you received the loan proceeds. This also defines the covered period, where you have the traditional covered period and the alternative payroll covered period that Denver has already gone over. I know somebody had asked if we could go over the checking of the box if you have greater than $2 million in your loan. This helps explain this process, and I'll show you where it is in the application as well. This gives all the details for where the underlying research is that defines the $2 million threshold. Go to page 2. This just walks through how the calculation works. And if you have any questions on what each line ultimately means, this gives some definitions for each one of these lines. Again, Denver's gone through all these, so I'm not going to go through them in detail. Bottom of line 2, it goes over and talks about the eligible payroll costs, and then it also shows the eligible non-payroll costs. Some specific items in here. It's the covered mortgage obligations. So there's questions about the payment of interest if you have a mortgage. Remember, it's for real and for personal property. So personal property, that would mean if, for example, you had company vehicles, or you had a copier, or other heavy equipment that you had a loan on. That would be your real property, quote unquote, mortgage interest. Covered rent obligations, similar situation. You've got your lease payments on your actual lease agreement. Remember, has to be enforced before February 15th of 2020. This would cover, as we said, real and personal. So real would be your, your operating facility. The personal property would be other leases, copier, other equipment leases, etc. So make sure you get all those accumulated, and you get all those lease agreements organized and ready to go. Non-payroll, as mentioned before, non-payroll costs cannot exceed 25% of the forgiven amount. All right, we'll go into the actual application now. Again, many of these items are pretty self-explanatory, but we'll go over some key items that I think are a little quirky enough to discuss. You'll need to define what your payroll schedule is. This is where you'll mention weekly or bi-weekly, bi-monthly, monthly. If you have other, of course, you click other. I think we've talked about as well that you've got that alternative covered period. So if you only have it checked either in twice a month or monthly, you would not have the alternative covered period because it must be bi-weekly or more frequent. Again, here's the place on the application where you would check the box. So if you're a standalone company and your loan was $3 million, you would check this box. If you had multiple companies that aggregate to $3 million, you might or might not check the box. All right, let's keep working our way down. As you can see, we have lines 1 through 11. We will go through a simple example right over here shortly. In fact, I think we're going to go ahead and flip over and do that now. Bear with me here. All right, so as everybody can see, you've got these examples, this actual application. Lines 1 through 11. Some are input and some are formulaic. Some of these items come from other inputs on your PPP Schedule A or the worksheet itself. We tried to make this simple for this presentation so that you all we're not going to be focusing on everything that you're going to have to do. There's so much you could do here. We could spend a couple of hours. We don't have that time, and you wouldn't stick around for it anyway. So what we have here is 3 different examples. Keep it nice and simple. Same company, 3 different scenarios. In this case, we have a company that received a PPP loan amount of $812,500. Remember, that's based upon 2019 wages, or if they weren't around in 2019, it'd be from the beginning of 2020. So that was a 13-week period that they gave you. They gave you 2.5 months worth of wages. You're only going to get forgiveness for this 8-week period. Stiffer said there might be some additional back-end funds during the 8-week period that would be eligible, so it might be a little bit higher. But let's just assume in this first scenario that the wages were flat for this applicant. The rent for all of these is going to be $140,000 for that for those 2 months. Remember, it's 8 weeks, but you're going to have rent paid twice. Then your utilities, and make sure you're capturing all your various utilities that Denver had gone over, and it's listed in the presentation. Interest. Now, people keep asking on the dealership side, should floor plan be included in there? The answer is it's not defined yet, and ABA is considering how much they're going to go into this, and I think they might be working on it. I would likely include it in there. I'd likely would include only for vehicles that were on the floor plan February 15th and prior. There's going to be other questions about service loaners. Again, if you have the loan agreement in place before February 15th, I probably would include it and then work through it with the people who review your application for approval. And then under this scenario, we're going to drop a $5,000 wage reduction. The rest of this is, for the most part, just formulaic. So under scenario 1, we have flat wages. We have FTEs during the period in 2019 as discussed, and we have number of FTEs during the first 2 months of 2020. So in this case, you take the lesser of these two, so 85 and 90, lesser is 85, and then you look to see what is your calculated FTE during the covered period. In this case, it's 86 because they kept their payroll about flat, and therefore they're not going to have an FTE reduction. Scenario number 2, you have flat payroll, 800,000, wages went down. You had to reduce. Maybe you were able to get your wages back up, and by June 30th, you were able to get it higher and your FTEs higher. We're not going to go into that detail of the forgiveness, the restoration piece, but this allows you to see. Under the scenario number 1, we didn't have quite enough expenses to get all of it paid. So we have a loan amount of $22,500. Under scenario number 2, our wages went down. We had to reduce, or people didn't make as much, and you didn't feel comfortable with restoring those wages with bonus or higher hourly wages or whatever it might be. But all of our underlying non-payroll costs are consistent: 140, 40, 15. Those add up to 195,000. Your total potential forgivable cost is 735,000. Under this scenario, it gets reduced by 5,000, which is 730,000. Now, dropping down below, this is where the fun starts. We had a reduction in people, which reduced our wages. In this example, we had 70 people. We had 75, maybe we didn't reduce by as much, it would automatically update and recalculate. Remember, it's based upon the lesser of your period, the period during 2019 versus your first 2 months of 2020. Under this scenario, let's go back to 70. You have a reduction of 18% because you had an 18% reduction in your number of full-time equivalents. That will adjust your potential $730,000 here, where it's reduced to $601,176. So you can only get the reduction of the lesser of these last 3 lines, 8, 9, and the piece for 10. Okay, so under this scenario, the loan amount is going to be $211,324, 1% interest over a 2-year period. Not bad. It's a good way for you to continue kind of funding your operation going forward. And there are going to be a lot of businesses that just could not justify bumping their payroll back up, and that's a business by business decision that has to be made. We'll go over scenario number 3. This would be like the nursery where you go and you've been bored and you've bought a lot of plants. That's like me. They are doing pretty well. They've probably had to ramp up their people. So same loan amount, payroll went up, rent stayed the same, utilities stayed the same, interest stayed the same. They probably didn't have a wage reduction, but we're going to keep it consistent here, just in case they had a couple of people that did. Full-time equivalents, they had 85 in 2019, they had 90 in the first 2 months. They were able to add people. Well, under this scenario, they're not going to have an FTE reduction, which means they don't have a quote-unquote penalty. So since their loan was $812,000, they had $875,000 worth of eligible expenses. They're going to get all of their loan forgiven. You can see that you don't get more than your loan forgiven. You get a loan amount of $0. So I hope this gives you a visualized way to really see what the effect would be of your company based upon a couple of different scenarios. All right. We're going to jump back over here to the application, go over a few other items that we feel are worth going over. I know Denver's already touched on many of these, but we'll go ahead and emphasize. Ooh, that got really big. Let's not get quite so big. All right, so this is your certification. So your authorized representative, likely the same one who had to sign off on the application itself, is going to have to go through and answer each one of these. I'm not going to read them all to you. You can read them yourself. Key item I saw here was the compensation of owner, employee, or self-employed. And here's your signature of authorized representative. We'll go to the instructions for PPP Schedule A. Again, this talks about line 9. That's the key item that I think would be worth you looking over. All these other line instructions are very helpful. I would absolutely, if you haven't already, get this form downloaded, print it, read it, reread it, make sure you're really comfortable with it and understand it. Schedule A. We did not show you all of this calculation. This is relatively simple as you work your way through it. So we'd recommend you work your way through, and then you can see right here, this is the payroll. This is your non-cash payroll. Well, it's still cash, you're still paying it. It's just not your quote-unquote compensation payroll is up here. Employee health insurance, employee retirement plan, state and local taxes. And then you can see you add on your compensation to owners. This is why when Denver was mentioning, we're not sure if employee health insurance for owners is includable because it's down below. That's why that question is there.
Hey, Colin,
Sure. Yes, Denver.
back on that one, I actually saw a question come across about the FTEs, if you get to count them for the owners or not. Something
Mm-hmm.
interesting that I just thought of, or if you read that part on line 9 where it says, or wait, yeah, it says this amount may not be included in PPP Schedule A, worksheet table 1 or 2. When you read through the instructions, it doesn't want you to put anything related to the owners on table 1 or 2. And table 1 or 2 are where you determine your FTE. So I'm curious if the owner is even going to count as an FTE when you do the calculation, but that's something we'll just have to find out later on, but just something to think about.
Yeah, that's a great one to bring up. Thank you, Denver. All right, we'll go down to page number 5. And again, we're not going to go over all these. We're probably going to stop and flip back over the presentation shortly. This helps define the average FTE, talks about the salary, hourly wage reduction. Denver's gone over this in detail, but this is where it's all defined and how it works and how you're going to populate it. You have the FTE reduction exemptions and the FTE reduction safe harbor. This helps define what Denver has already gone over. And then lastly, this is the worksheet that you've seen a couple of times in Denver's presentation, but I'm just showing it to you here so you can see it's the exact same thing. And then documentation, literally, documentation. That's what this is all going to be about. You've got to make sure that you document. Think of it as if you're going to be going through an IRS audit, you want to make sure everything is in order. You've got a good spreadsheet that documents everything that you consider to be eligible, why it's eligible, where the support is, have that support quote unquote behind it or in a file or printed out, and just document away. But this helps explain what they're asking for in documentation for each item. So, all right, last item that I wanted to go over before I turn it back over to Denver is this highlighted point at the bottom. The borrower must retain all documentation in its files for 6 years after the date the loan is forgiven or repaid in full. So that's your audit period. There might be, while up front, there's going to be a review by either a representative at the bank or by their independent third party who's going to be reviewing all the applications. This gives them the right to come back at a later time and review all that detail if they so choose. All right, Denver, I'm going to turn it back over to you.
Hey, Colin, before you
Yes.
close that sheet, I want to make one comment that, so as far as I know, it's going to be the banker that is going to be reviewing all this information. What's interesting though is right there where he's at, it says documents that each borrower must maintain but is not required to submit. The PPP Schedule A worksheet, which basically does all the calculations, you're not even going to have to submit that. So that makes me bring the question, how much are they going to really be looking over all this documentation to verify if there were mistakes or whatnot made, if you're not even providing like the source of all the data? So that's just something to consider, but it's kind of interesting. I don't know if they'll be just rubber stamping all this, but you got to keep the documentation, obviously, but just something to keep in mind.
Absolutely. Agree.
Okay, so I will go back to the PowerPoint 1 second. Okay, with that, we're almost to the end here. We have CPE question number 3. So the amount forgiven is the lesser of A, B, or C, or all of the above. And there's a box that's going to pop up again, like I mentioned before. Just mark yes if you're watching. I think if you mark no, that might affect how much CPE you get, so make sure you mark yes. And then remember to keep the answer for this one, as you will need to submit it when you apply for your CPE. And I am going to keep going. The answer is all of the above. Okay, so best practices.
All right, I'll talk a little bit about best practices. As most of you have already received your funds, the question is, what do you do with your funds? Should you commingle? Should you segregate? I know a lot of companies, they're not segregating those funds into a separate account. It would be great if you could. And then as you have eligible expenses, move those funds over to either your payroll account or your operating account for use. If you keep them all in your regular operating account, make sure you document what that balance was, the date that you received the funds. net of those funds, your actual funds. And then you're going to have to make sure you build that spreadsheet and document everything, as we already mentioned. So question is, if you have eligible expenses, what should you do with those? It's really up to you, but I would recommend you treat those expenses exactly as you would otherwise. Don't accumulate it as a reduction. Treat it so you can truly see how your operations were performing during this period. And then what do you do about that liability? You know you're going to have some of it forgiven. You don't know exactly how much. However, do you take that into income or do you wait until later? I would certainly wait until at least you've gotten the approval and actual reduction. And then you determine how you want to handle that liability coming in on your books. Got to be careful. I'm not going to go into all these details because we have on prior webinars, but you got to make sure that you're not adversely affecting compensation by the way that you bring that in. All right, let's go to the next line.
Yeah, just before we get into the commonly asked questions, just real quick, this is where you can get the most updated information about the PPP loan program. If you go to treasury.gov, you're going to see a red line towards the top of the web page where you can click a link. And once you click the link, you'll go to this page where it has all these tools where you can find information. I haven't updated this screenshot in a while, but right down here, so under program rules, frequently asked questions, it says April 23rd. The latest, I just checked the website, was yesterday that they updated it. So if you want to be up to date on when new information is coming out, just check the FAQs right here. And also they will release additional information down here. And if you were to go to it right now, for borrowers, there would be another item for the PPP loan application. I saw someone asking about that in the questions. Okay, so we're in the commonly asked questions, and Patrick's going to take it from here.
All right, thank you guys. I think what we're going to start with is, what if I paid an employee more than $100,000 in Q1 of 2020 for a new business that started in 2020? Will these employees be excluded from the salary hourly wage reduction test?
Currently, how the law is written right now and then application instructions, they would not be excluded from that test, and you would have to calculate to see if there was a reduction. The employees that are exempt from that test are only employees that made 100,000 annualized for any pay period in 2019.
And what happens if someone is employed in Q1, but they are fired or quit before the 8-week period begins? Do they get included in the forgiveness reduction calculation relating to a reduction in pay?
So they don't get included in that calculation because how the application states, you have to list your employees in table 1 or 2, and you're only including employees that were employed at any time during the covered period. So the answer is no.
How about to remedy decreases in payroll? Can I provide a bonus to new or existing employees?
The answer to that is yes, you can. But you have to be careful about not paying more than the annualized $15,385 during that 8-week period. So if you hire them at the beginning of the period and you pay them a sign-on bonus, or you pay somebody a retention bonus, or what many call in various industries spot bonuses, you can absolutely do that to help with what you consider the stars who are going above and beyond in this uncertain time. But let's just say, for example, you hire somebody 6 weeks into that 8-week period, and you pay them a pretty good size sign-on bonus. You wouldn't annualize it based upon the 8-week period. You would annualize it based upon the time that they were employed. So if they were employed for only 2 weeks and you paid them a bonus, you would take the amount of compensation during those 2 weeks, multiply it by 4 to compare it to the $15,385, which is your max per employee during this period.
To add on to that, we haven't seen anything for definite yet, but I think that also applies to if someone was fired within or let go within the 8-week period, or they just left. I think you'd only do the average where you have to come up with their annualized wages or their hourly, you'd only do it based on the time period that they were employed during that 8-week period. You wouldn't, if someone quit after 1 week in the 8-week period, I wouldn't average it over 8 weeks because they weren't working the 8 weeks. They were only working that 1 week. So that's how I would do it. I think that's how they're going to come out and say you have to do it. That's how I do it going forward. And one other thing to mention on here, as I mentioned before, you have to watch out if you're paying. We don't know the full definition of what a owner employee is yet, but it seems that S Corp shareholders might be limited in how much they can pay themselves and count it towards forgiveness if they weren't being compensated in 2019, or they were just, their compensation wasn't that significant. So just something to watch out for. And then the last thing is you could pay them at any amount that you want for regular employees, but if they're employed for the whole 8 weeks, only the first 15,385 counts in the calculation.
All right, thank you guys. Moving on to some questions about the forgiveness side. Can my rent be considered for forgiveness if it's between a related party?
Yeah, I would think that as long as you have a executed lease agreement that's dated before February 15th of 2020, yes, you would. And I think your second question there, I'm sorry, sorry, Patrick. The second question there, where if you're a related party mortgage, so you've got a company, and of course you would set up your the real property, the facility where you operate in a separate partnership. If they had a deferral, does that deferral have to be taken into account when charging the related party? I believe the answer is no. You can choose not to charge the rent, but I don't believe that they would have to mesh together with that obligation.
The IRS came out and said you can't deduct expenses that were forgiven. Is there any change? Are there any chance that that will change?
You know, they've certainly been talking about it. I think there was several instances where the expectation was, or the intention of in Congress was, that they wanted these to be deductible expenses. So there's actually some discussion that Congress is still working on this, and other parties are still working on trying to get us a resolution that would allow the expenses to be deductible as well. Now, we can only hope. Maybe you reach out to your representative and see if they'll go to bat for us as well.
And I know you both touched on this a little bit before about possible changes. Are there any change in the covered period? You know, right now it's 8 weeks. Will that be extended? What are your thoughts on that?
I mean, I certainly don't think there's any guarantee it'll be extended, but there's certainly discussion about it. I've heard a couple of cases where they're hoping for a 24-week period. We've heard other rumblings where they're talking about extending it through the end of 2020. But right now, that's all in theory. There's nothing out there that's imminent or that we know will actually happen.
And then finally, on these commonly asked questions, before we get into some from the panel or from the participants, what happens if someone quits during the covered period or is hired during the covered period? How does that affect the cap of the $15,385? And how does that affect the hourly wage reduction tests?
That one was discussing just a minute ago. I think it's going to be based on how long the employee was actually employed during the covered period. If someone comes in week 8, I think it would be annualize their pay in that 1 week and not annualize it as if they worked the 8 weeks, because they're really only there the 1 week. And I think the same applies for if someone was fired, you'd only annualize based on the time that they were there.
So some of the questions from the participants that came up, specifically about that average hourly wages, Denver, that you were talking about before. How does overtime fit into that?
That's a good question. I haven't seen anything on that one yet. Based on what they said, they don't differentiate between overtime and regular hours, I would think you'd have to count the overtime for now. And in that example that I provided, someone worked 50 hours, but I don't know the answer at this point. This is the application that's come out and the instructions. There's going to be more narrative guidance that will go through more of these really questions that are out there and hopefully answer them. But at this point, I would think you'd have to count overtime hours.
Okay. And I know we've covered this in past webinars, but just to reiterate a little bit, when doing payroll cost, can you include full-time contractors in that cost?
No, I mean, contractors are 1099. They would need to be W-2 employees.
Yeah,
Okay.
the reason is the contractors are going to be able to apply for a loan on themselves, and they don't want people double dipping. The company gets to count the contractors, and the contractor also applies himself. It's just more money being loaned out.
Still on the payroll cost side of it, if you were to use a third-party payroll processor, could those fees be included in your payroll costs?
I don't think those fees fall under the definition of a payroll cost.
And then what about if the employer was to make 401 contributions or HSA payments on behalf of the employees?
I think that falls into the healthcare costs. As long as it's employer paid, that would go into that category.
I'll mention one other thing. I know a big question that's come up is that around this time of the year, a lot of people do their profit sharing from 2019, for example, and they'll contribute to employees' 401k or whatnot. And a big question is, can I include that profit sharing as an expense? I mean, it's for basically incurred back in 2019, but you're paying it in 2020, and can you count that? And it's a huge expense usually, sometimes relative to other expenses. I don't know the answer to that, but I just wanted to throw that out there because that question gets asked a lot. We'll have to find out once the guidance comes out.
And then, do you guys have any indication of when these forms will be due after that 8-week period? Is there any deadlines that you're aware of at this point?
I haven't heard any specific deadlines as far as having to turn them in. I haven't been able to find it. At one point I found that there was a deadline for their review and approval of the forms, but I'm sure we'll get guidance on that as well. You know, and part of it is, since we don't know about what the ultimate covered period is going to be, if you jump on this, like if yours is up in early June, let's just say, for example, and you jump on your forgiveness application that day, and then at a later time they come out and they give guidance that says that your covered period can be extended for that 24 weeks or to the end of 2020. Well, you've already done your application. I'm not sure if you'll be able to do a second. So I would say, since it's a 1% interest, you might not want to be completely, aggressive at getting it in. Be ready to turn it in, but if you get guidance that is advantageous to you, I would wait a little bit just in case and see if something comes out that'll help. We are getting a little short on time. We can run over a little bit. But,
just to add to that point, the form actually has expiration date on it, which is October 31st, 2020. So I'd assume you'd have to file the form before the form expires.
I do see a question. I neglected to mention this. We are assisting clients and other people with the application. We would happily be able to assist you in either reviewing it or in some cases completing the application. So just reach back out to us and we can certainly help you.
Yeah, there's a email address at the bottom. If we didn't get to your question, feel free to send the email there, and then we will try and get back to you.
We have time for maybe one or two others, Patrick.
Okay, I'm trying to go through. I've got a big list of questions I've been trying to answer along the way. If you are using, can you reiterate? I think you did go over it in the slide, but if you're using the alternative payroll calculation and you have a payroll that is bi-weekly, that only 1 week is covered in that 8-week period, and the full amount is paid the week after that 8-week period, right? What portion would you be able to include in your payroll costs? Would it be a week's worth, that whole payroll, none of the above?
I think it'd be the portion of the payroll that cost that's been incurred up to the date, the last day of the alternative payroll period. So if let's say, okay, let's say it's a week and your period ends on, your payroll period's Sunday through Saturday, and the period ends on Monday. I think you'd get to include those first 2 days as incurred and the costs associated with those 2 days, but I don't think the remaining days of the week would count. Does that make sense a little bit?
Yes, I think that covers what we're looking for on that. What happens if we have funds left over after this 8-week period? Do we continue to use those funds for payroll? Do you have any recommendations? I know that we've kind of talked that the way right now the calculations work, it will be very hard to get your loan fully forgiven.
Yeah, I can jump on that. Yeah, if for example you had an $800,000 loan and $700,000 was forgiven and $100,000 was left, if you decide you want to repay the $100,000, you repay it. If you want to use the $100,000, the way they have it defined is you need to use it for eligible costs. That would still be the same bucket. You wouldn't want to jump out and say, I'm going to go ahead and pay a distribution or pay down a loan or something along those lines.
And one thing to add on, I think a lot of people might be able to get pretty close to the loan amount for their payroll, non-payroll costs because of how the definition is paid or incurred. So it's a very favorable interpretation by the application. So I think if people are able, once they're able to add those additional payments, essentially, their costs are going to go up. So they would focus more on their reductions to make sure they don't get hit by the reductions. But I know everyone's different. Everyone has different scenarios. But I think this interpretation is probably very helpful for people in a sense that they're going to have more payroll costs and non-payroll costs that are going to qualify.
I do want to go ahead and address, I know there were a couple of questions about CPE. We mentioned at the very beginning, but I know some of you didn't get on until a little bit in. Once this finishes, you will see a Survey Monkey. And once you complete the survey, enter in your codes, you should get access to download the CPE. If you're unable to do that or you have a technical issue, you should get an email within 24 hours from SurveyMonkey. Again, complete it. You'll then have access to download the PowerPoint presentation and be able to get your CPE. If you have any issues, you can reach back out to ask us at lgt-cpa.com, and we'll happily help you with getting the CPE for this webinar. Again, we'd love to have you join some of our other webinars in the future, and really do appreciate all the efforts that Denver put into pulling this all together, and the rest of the team for all their assistance. And thank you for joining us. Love to hear from you at some point in the future as well. Thank you all.
Thank you for joining us. As this situation is constantly evolving, please make sure to follow our events page for more information. Link is in the description below, along with other important links, including our social media. If you want to see more of the past Lane Gorman Trubit COVID-19 financial webinar series, subscribe and hit the bell icon for notifications. Thank you and have a great day.